Sir.
Hi, good evening to all of you. First, let me clarify something which is correlated to my introduction as well as the topic. If you had seen my performance last year, you would not have repeated anything which Jyoti repeated. We talked in equity that good days are coming, achhe din have come, and markets went down 20%. Equity is volatile. One can pardon someone going wrong on the equity side, but fixed income, Jayesh Bhai, is, after learning from you, we should have excelled in that. But even after your teaching, we failed in fixed income as well. We said rates will come down, and Jayesh Bhai, kind of charitable person, will say that yes, of course, RBI did cut rates, but no one pays the fund manager for predicting RBI's policy rates. They pay us for making money. And there also we failed quite miserably. But touchwood, 2016 has been a bit different. We are becoming right on more counts in 2016 than we were wrong in 2015. And that is the best learning. In today's world, we have to remember that no matter what your experience is, you are still student of the market. You are not the master of the market. Fortunately, in my job, I get to learn every day because there is always someone who is doing better than me, and my distributors always tell me that, ye sab theek hai, but you are behind this guy. So I come to the ground every day, and which is good. We are living in a world where there are many questions for which there is no answer. In my whole life in school and college, no one taught me that interest rates can be negative, and for borrowing money, you can be receiving interest. Today morning, I saw a presentation in Bloomberg where Ben Bernanke's 2009 quote was given, where he said negative interest rates, they don't work in monetary system because lenders will keep money in cash rather than lending out at negative interest rates. The same gentleman, after leaving US Fed, in 2015 is making a statement that negative interest rates, maybe we should experiment with it. Maybe US Fed should use it if and when it is necessary. So a gentleman like Ben Bernanke, after managing US Fed, is changing his view within just about 6 years. We are unable to comprehend certain things which is happening in global market. So in 91, India came into crisis. We had less than 7 days of foreign exchange to import oil. In 1998, Asia came into crisis. Indonesia, Thailand, Malaysia, Philippines, Korea, Taiwan, they were all coming down heavily. Now in both this era, Dr. IMF came and prescribed certain medicine. They told us that you please cut subsidies, please cut government deficit, please open up for those resources which you are in short. India and Asia was perennially short in capital, so please open up yourself for foreign direct investment. Please depreciate your currency so that you can export yourself out of trouble. Please try to remove government from every sphere of economics. Essentially, they gave us medicine which created short-term pain. And fortunately for us in Asia, we accepted those medicines, and today we have come out far better than we were in 91 or Asia was in 1998. Now this is something which has worked. It's there for world to see. Now in 2008, there was a crisis in North America on subprime. In 2010-11, there was crisis in European Union. And what have they adopted? We were told, reduce your fiscal deficit. In both this continent, they have raised fiscal deficit. We were told, depreciate your currency. In both states, the currencies haven't depreciated much. They have depreciated a little, but not much. We were told that you open up your country for that thing which is in short supply to you, essentially capital. Now in Europe and US, they are short in labor, so they should open FDI in labor for themselves. We were told to remove government out of everything. Their government went and acquired everything. We were told that central bank should not be used to fund your deficit or fund your economy. There, the central bank has run out of dictionary in terms of launching programs. Now, I'm unable to understand why can't the world learn from successful practice and copy that, and why are they experimenting with something new which is not going to give any result? Japan has been doing this for last 20 years and they have failed miserably. And I don't think so for next 20 years they are going to succeed. So there are lots of questions for which we don't have answer, and which is why it is important for us to be a student of the market, be nimble, remove your ego on the side, take the market on a daily basis, hope that you are able to talk to as many people, network to as many people, and try to build a position which is probably lying low on most part of the day, and then taking an aggressive position when you are sure about whether you are going to make money or not. It's more of a Rahul Dravid style rather than Virendra Sehwag style. If you stay on the pitch, you will make money, provided you haven't lost your wicket. If you see the equity market over last 15 months, it's the month of March which has delivered more return than what you could have lost between June 2015 to Feb 2016. Similarly, in fixed income, month of March has delivered more return than what you could have lost between June 15 to Feb 16. It's important to hold on to your wicket, hold on to your position, and build a bigger position when you're confident. Unless until you have that kind of nimbleness, it's difficult to succeed in today's market. Very easy for me to tell, very difficult for me to demonstrate. But fortunately, March has been good. 2016 has been good for us, so I can make that statement. Thank you.
Thank you so much, sir, for that insights. It's time for us to get into the Power Pack session, where our panelists will take a deep dive into interesting world of financial markets and discuss some interesting aspects about it. I would like to introduce the panel which will be taking over the session shortly. And I would request the panelists to come to the stage as well. I would like to introduce Mr. Jayesh Mehta, Managing Director and Country Treasurer, Bank of America, and heads the Fixed Income, Currencies and Commodities business for the combined platform for Bank of America, DSB Merrill Lynch. Mr. Mehta is responsible for all rates, currencies, credit, and commodities businesses, and also has client coverage responsibilities for both domestic and international accounts based in India and Indian accounts based overseas. Thank you, Mr. Mehta, for coming over and being a panelist. Thank you so much. It's my great pride to... Bhishma Pitama. Thank you, Bhishma Pitama. Fantastic.
That's our way of reminding him of his age.
Okay. Fantastic. May I request JJ sir to give the bouquet to Jayesh Bhai, our Bhishma Pitama friend.
Frankly, I'm trying with you that I learned my treasury as a classroom from him.
Wow.
In 94-95. I will never forget that day. It's my pleasure today that I'm sitting with him in the same panel. It's a dream. But I learned the yield curve of the bond market from him in a classroom.
Awesome. Fantastic. So I guess this is just not epic for me, it's epic for you also, sir.
It's easier to count people who haven't learned from Jayesh Mehta in that market.
Fantastic. Due to some emergency, Manisha Gupta couldn't make it as a moderator, but we have someone extremely brilliant and hands-on, experienced, and it's my delight to introduce Dr. Brinda Jagirdar, who is a panelist and moderator for the session, and I request JJ sir to give her compliments. Thank you. Dr. Brinda Jagirdar is an independent consulting economist with specialization in areas relating to Indian economy and financial intermediation. She is an independent director on corporate boards. She is visiting faculty with National Institute of Bank Management and a member of the Research Advisory Committee of Indian Institute of Banking and Finance. She retired as a journal manager and chief economist from our largest bank of the country, State Bank of India. Thank you, ma'am, for coming. And yes, this is another epic introduction of JJ sir, who is our panelist, and a request, Anushree, to please hand over a bouquet to him. Okay, even Abhishek would. Fantastic. That's how much we love you, sir. JJ sir is a CFO and corporate finance of GMR Group. He has more than 21 years of strong background in financial markets in areas such as treasury and forex management, equity as well as debt capital markets and corporate finance, investor relationships and M&A, asset liability and risk management. What a mammoth combination you're putting together, sir. And I will request Brinda ma'am to moderate this session where the panelists would be discussing our topic of the day. Are we going to see a new normal in the VUCA world?
Thank you, Jyoti. First of all, let me congratulate Mr. Abhishek Gupta on this great initiative. And I wish this initiative and this step every success. Today we are going to discuss, of course, what's happening in this new normal world. You remember in 2012, India was counted among the fragile 5. And today in 2016, the world is looking at us as the only bright spot. So I think we've come a long way and managed pretty well in this volatile world. Just to go back a little bit, just to touch on the economic parameters before I throw open this discussion. GDP growth is likely to stay, well, not very high because 7.3 to 7.5 to 7.6 in that range in these 3 years, largely because the global economy itself is not growing very fast. And so far as inflation is concerned, is it okay? We have been able to. The RBI, Governor Rajan has done a tremendous job in actually bringing down inflation and inflation expectations. But going forward, we will have to be a little watchful because this inflationary factors of low global oil prices, low rural wages, as well as, of course, the negative output gap that was there. Now, all these things, and of course, the food inflation is something we need to still be watchful about. So far as fiscal deficit is concerned, that of course is also very much under control, and the government is committed along with the new monetary policy framework. And the current account deficit, we had 4.8% as close as 2013, and today we are around 1.2%. So Indian economy is quite comfortable, quite stable, and well poised to move forward. In this environment, are we going to see this kind of a situation continue? Let me start with, of course, Ms. Jayesh Bhai, and mainly because the Reserve Bank has actually probably read his mind and listened to what he was saying, and opened the liquidity tap, which is really what has really enthused the markets. So let me ask for your comments on this first.
Thanks. Congratulations, Abhishek. Good job. Hopefully, we'll have more larger audience. Maybe your target of 5,000. That's what, 1 year?
5 years.
5 years.
But we always like to break our targets.
I'm basically an optimist guy, so
Yeah.
I always try to push
I'm with you.
push the envelope, right? So, I think, of course, yesterday's day before policy. Firstly, let me say it's very difficult to say anything after Nilesh Bhai speaks. It's always better to hear him, and we should do only Q&A. But since I've been given a mic, and normally I have a very bad habit, I never prepare anything, so I'll just go ad hoc and I may jump topic to topic. So maybe to first go on the credit policy, I think this is really a very nice thing which they have done. I think people have still not realized that 25 basis point rate cut with liquidity stance being changed is much higher and much better than even 50 basis point rate cut if you would have given with no change in the liquidity. Maybe to, and this is we have been harping since long, and maybe to put a simplistic word is like today if RBI, whatever liquidity they provide in repo, that's system deficit liquidity. And normally in repo when people borrow is against their own collateral, and it's the money not in the bank's pocket. So unless banks have money in their pocket, which is if there is permanent infusion of liquidity, banks are not going to spend. So it's like a normal leverage finance on equity or whatever it is. So unless you have, you know, really need for it, you will borrow money, and that's what typically all this borrowing used to happen to manage their frictional shortfalls and stuff like that. In that situation, they are not going to expand, whether it's loans or corporate bonds or government bonds. I was always amazed as to when we say about transmission not happening on the lending side and all this stuff. I think the first and foremost transmission always has to happen on the government bond side. It's just like, you know, you talk about whenever you're investing, new investor coming to a equity market, he would look at Sensex or Sensex equivalent stock and not straight away jump to private equity or mid cap. So that's the way it should follow. It's bond yield, government bond yield has to come down. The transmission of 125 basis point rate cut last year, which we all went right on what they did, but that was not followed up by liquidity, which didn't transmit, and 25 basis points. So we have 150 basis point rate cut in last 1.25 year. Hopefully with this transmission, it's a real game changer, because I think if you look at it last 3 years, because of the volatility on the FX side and fighting inflation, we have been system deficit liquidity. Even before that,